Here we go. Getting ready to take you on a ride through this mess called the stock market. 3, 2, 1. We have liftoff. All controls are go. And thank you very much for joining me. I'm Mitch Goldberg, your host. You're watching my live stream. It's called Be the Boss of Your Money, because I really want you to be the boss of your money. And we know how easy it is for your money to become the boss of you. So let's get started. We've got a down market. We have corrections in so many stocks, although you still might not notice it because the S&P 500 is barely down 5%, not quite 5% from its all-time high. Looks like we'll break through that. We did break through that intraday, but not by the close. In any event, it was another tough day in the street. Normally, a day like today would be notable, except that we've had so many 500-point plus down days in the Dow in the last 2 weeks that it's almost becoming commonplace. Like we might have a day where the Dow is only down 200 points and say, wow, that was a good day today. In any event, we're going to talk about that. We're going to talk about how the quarter ended for the stock market. We're going to talk about the month. Where do we go from here? The point of the show is you better know what you own if you're an investor. You better know, because I think a lot of you are relying on the same stocks, all in the same boat together. And some of the stocks you are in may be getting smoked right now. And you have to wonder, are the conditions still there for these stocks to keep going up and maybe resume their climb? Or have conditions changed so much that you need to start thinking more in terms of your risk tolerance as opposed to what you could find the best, quickest return in? So let's roll the quick intro. It's going to be a good show today. We're going to learn a lot. I love learning. I love teaching. If you have any questions, you know what to do. Please hit me up with your questions in the comments. Words of wisdom, words of encouragement are always appreciated as well. Here we go. All right, we're back. If you're just joining me, if we haven't met yet, my name is Mitch Goldberg. Everyone calls me Mitch. Please do so. If you have any questions about the content that we're talking about during the live stream, hit me up with those questions in the comments. If you are watching this in the replay, same thing. Ask your questions in the comments. I'll get the notification. I'd love to answer your questions, and it's actually the best part of doing the live stream is the banter. I always say words of encouragement, words of wisdom are appreciated, but wisecracks, sarcasm, jokes, as long as they're not too dirty, are always appreciated here as well. So if you have something to say it, or hold your tongue, whatever it is you want to do. We had another really crappy day in the street. And, that's the way it rolls. We've been talking about a potential correction in the market. The market's going to go down sometime. And it looks like we're getting it right now. Now, we fell into the close. So we just finished the third quarter. We finished the month of September today. Yeah, it's September 30th already. I can't believe that 2021 is going to be over soon already. Isn't that crazy how fast the year went by? I thought 2020 went by fast. This year's even faster. We're going to talk about what's really behind the constant selling. I think I'm not saying we need to overthink it, but I'm not saying that we should ignore changes. All right, does that make sense to you? So let's take a look at the overall averages. Let me pop myself up. Probably be helpful if I had what I wanted to show you in the screen. So let's take a look. Big headline of the day: Dow drops 500 points on September's final day. S&P 500 suffers worst month since March of 2020. If you recall, March of 2020, there was a huge drop, right at the beginning of the pandemic. This month wasn't quite as bad. The Dow is off 1.6% today. All the major averages were down. It's a shame because we started to look like we were going to have an up day. When I woke up this morning at about 6, the futures were up, and we're thinking, finally, we're going to have a good day. Everything's going to be okay. But we have these downdrafts at the end of the day every day, and that to me is a pretty negative call. Let me make this a little bit. Let me make this bigger so you could see it on your smartphone. So September lived up to its reputation and dented stock market portfolio returns, but not too badly. We're still having a pretty good year, guys. But it really depends. Bed Bath and Beyond, that's like the big story of the day. We're going to talk about Bed Bath and Beyond. And what else do I want to show you is, hold on a second. This is what I want to show you. Okay, take a look at this. So here we go. Is this magnified? Yeah, 200%. All right. So the Dow down another 550 points or so. Nasdaq down another 60 points. S&P down another 51. These are real drops. Anything a 0.5% or more does get my attention. Over 1%, you've got my attention. Over 2%, you've got my attention. But it does seem like things are not looking great. Gold had a little bit of a bounce back. I wouldn't call it an update for gold. I would call it more like a bounce after a horrible week. Oil continues to rally. The oil sector was the best performing sector of the month. The 10-year Treasury backed off a little under 1.5%. If you recall, what I said yesterday is that, let me pop myself up on the screen here. Okay. In fact, let me just go here. If you recall, what I said yesterday is the foreign 10-year equivalents, 10-year Treasury. We have our 10-year Treasury at 1.49% on the close today on the yield. That's the main benchmark bond that we follow in Wall Street. But the 10-year bonds of Germany, of Great Britain, of France, of Japan, they're a lot lower. So in our yields, what I said yesterday is once our yields get up to the 150s, we spoke about this yesterday, that our yield attracts foreign buyers. Because if you think 1.5% is low, if you're in Europe, you think 1.5% on our 10-year Treasury is like a great deal, and you put some money into it. So that's one of the reasons why our Treasury bonds don't fly up too much with yield. I'm not saying this is not going to change someday soon or someday far out, but that's the story for the day. So let's go back. Let me pop myself up in the screen here. You have a question, let me know. And while you're watching this, give it a thumbs up, a heart, a support, applause, depending on what platform you're watching. Josh, I see you out there. Thanks so much, buddy. Really appreciate it. And let's keep going down. I want you to focus here on the VIX. The VIX was up 0.5 point, up 2.5%. This is encouraging, and this could be the end of this downdraft in the stock market. When I look at the VIX is the volatility index, and it indicates short-term nervousness in the stock market. And when the VIX goes up, stock market goes down, and it closed at 23 today. What I always say is over 20, the stock market's going down. When it's under 20, the stock market's going up, and that has held true to form, and we're going to stick with that. We're going to stick with that until it doesn't work. So the VIX is only up 2.5%. That's a pretty small amount for the VIX at 23. And you would think with the downdraft we're in at the VIX, I would think in my experience that we would see the VIX like 30 or 35 or 40. It's still below 25. And that tells me that maybe there's a little bit of calmness going in that should be next. That could be a shot in the dark, but what I'm telling you is the VIX is actually telling us that the fear has maybe peaked for now, and stocks could start a recovery. October typically is not a bad month. It's typically a good month of the year. Yeah, I know what you're thinking. Well, what about the crash of '87? And we've had some other tough Octobers. What about 2008? I'm not saying it's perfect. We have 100 Octobers to look at, and there have been some doozies in October. But you average it out. September is usually the worst month of the year. All right, so let's move on. The Russell 2000 was off point. That's Russ 2K. That was off 0.94%. And that's typical that would be down more than the other uh, benchmarks. What else are we looking at? U.S. auto sales forecast to plummet in third quarter as chip shortage plagues industry. I think the thinking was that the chip shortage would be solved, by the end of the first half of this year. Now we're going into the fourth quarter, and all of a sudden we're talking about the chip shortage. Semiconductor chips go in everything, especially cars. Now we're talking about maybe we'll have a problem, a shortage of semiconductor chips that lasts well into 2023. So it's hard to get excited about stocks like GM and Ford if you're worried about sales. That's what this is about. But Edmunds expects General Motors and Ford to have the largest third quarter sales declines of 31.5 and 29% respectively. Damn, that is a huge drop. And it's not just GM and Ford. This is a global problem. CarMax sells used cars. Carvana, these stocks have been getting smoked lately too, because there's just it's great that people want to buy cars. It sucks that they don't have product to sell. Can you imagine? Everyone wants to come into your store to buy your product finally, and you're like, "Yeah, I wish I had product to sell." It's like the worst thing. And let's take a look at Bed Bath and Beyond. This is a big story. It's a story that continues to plague us. Bed Bath and Beyond warning what it means for them and other retail stocks. So here's what it means. Have you been in a retailer recently? I went shopping recently with my kids, and let me just adjust the mic. So what happened is we went to a couple of stores in our local mall. We hit the Walt Whitman Mall on Long Island and Huntington Station. It's a lovely mall. It's a Simon Properties Group mall, and it's we we went around to different stores, and it's like, there's nothing, and this is before school started. This is our back to school shopping. And they have pants but not in all their sizes, or they have shirts but not all the colors, or they have sneakers but not the sizes, not the ones you want. And it's like this everywhere. And I don't know if consumers realize how bad the supply crunch is. The ports are backed up, and it's creating scarcity, and it's creating higher prices, higher prices for stuff that we don't even want. So that's what's going on. That's Bed Bath and Beyond just finally plummeted. The stock was down close to 25% today, and it brought down others like Kohl's. And I want to show you the big ETF, the Spiders ETF, the retail stock ETF. We put this up on the screen. Here it is. Okay. The symbol, okay, is XRT, and that's down 4.75% on the day, down a little bit more in after hours. So down over 5% today. And the high on it's 99. It's down to 90 at the close. Year to date, okay, that's the year to chart. Year to date, it's still up 40%, but I could see this area as rife or queued up for profit taking. Is that a better way to put it? And if we take a look at this ETF, the top 10 holdings are Group One, Auto, Designer Brands, Party City, really? Macy's, which got smoked today, Overstock, Penske, AutoNation, Asbury Automotive, Boot Barn, Boot Barn, Abercrombie. And you could see why this fund is getting smoked. And it just tells you that retail is probably not going to have a great Christmas. I don't think that's like a new news thing. I think that's consensus. But I do think retail overall is looking a lot worse than anyone imagined. The retailers look so bad. They can't get inventory, and what they could get, it is so expensive because of inflation. And by the time they get the stuff they order, the season's over. You know, like I mean, in the not too distant future, we're going to see like the day after Christmas are going to be sales for the retailers to blow out of their winter merchandise, and then come like February, you want to see the spring lineup, right? Spring clothing coming up already. So it's looking really really bad. So I want to talk to you quick about inflation. That is like the story that we talk about here. Every single day we talk about inflation, but especially the last couple of days or the last couple of weeks is inflation is such a big topic of conversation, and interest rates. Okay, so let's talk about stagflation. You hear that a lot lately, stagflation. How many of you remember stagflation? How many of you were alive during stagflation? Stagflation is the 70s. Okay, so if stagflation was during the 70s, I would say probably more than half of my viewers weren't even around at that time. They came later. But let's talk about stagflation. The economy in the 70s and even the 80s was very different. Today we have a very tech centric economy, and that's only growing. Our economy, if you take a look at the automobile sector, if you take a look at the steel industry, we are just not the industrial economy that we were. So when you hear about inflation and you compare inflation to the stagflation of the 70s, which I think is right now a really bad comparison, yeah, we're having inflation on a much smaller part of the economy, because you have to look at, if you're going to compare the 70s to now, we are so much more tech centric. We have the internet today. We didn't have any of this stuff. I mean, if you look at we didn't have the stuff in the 70s. If you look at the price of a cell phone call, the price of a cell phone, the price per unit of computing power, things are really cheap today. So let's not get carried away and say this is the 1970s. All right. I'm not saying interest rates can't go up. I'm not saying we can't have inflation. We do have it. I'm not oblivious to that. But let's keep it in mind that every time we have inflation, it's on a smaller part of the economy because we're so tech centric. Wage inflation, the cost of labor is going up in low end jobs, and that raises the entire price curve. Absolutely. I could also tell you that the travel and leisure and restaurant industries thrived on dirt cheap labor for a very long time, and those days look to be over. And if they are, what you're going to see is uh, stronger businesses that could handle the higher costs, and that's what's happening right now. The internet decimated so many retailers, right? And wage inflation is going to decimate so many restaurants and other travel and leisure related industries. But you're going to have are stronger businesses left over who will then grow. And this is part of the economic creative destruction that we're always going through. I'm not saying we should celebrate it, but this is how capitalism works. And since pretty much we all agree that capitalism is the way to go, you have to you can complain about it all you want, but you have to accept it. Okay. So that's my story. I'm sticking with it. We've got someone out there. And we've got Josh out there. Here we go. Let me just make my thing a little louder. Paper orders for large format printing is still 4 months behind. despite lumber prices dropping. Well, that is a very good fact for you to share with us, and I appreciate that, Josh. I had coffee today with a mutual friend of ours. Brad Levin in the packaging business, and same exact thing. Um, so pivoting is great option to survive times like these. Yes, sir. And talk about pivoting. Let's talk about pivoting.
Pivot! Pivot!
Yeah, that was my pivot clip. That's just so weird that I have that, right? All right. So, yeah, so prices are up. And a mutual friend of ours, Andrew Janicek, who's in the promotional products business, basically said if you don't get your orders in for your promotional products like right now in September, you could forget getting any of this stuff by the end of the year because you just can't get it. And it's all over the place. Thank you. Exactly. You're saying exactly to the video. Um, so that's what's going on. That's what drove the market down this month. It's not necessarily it's just because of September and it's September automatically goes down. In 2008, Lehman Brothers failed in September, and we saw how that worked out. But that's September. It's just when they went under. It has nothing to do with the month necessarily. I think a lot of things that could have happened in the summer are put off until after Labor Day, maybe. But so we've got three big things for investors to worry about. And the last thing I want to, the debt ceiling. Congress today, and I want to put this up here. Let's see. I want to get one more article in here before we go because this is noteworthy, and I really okay. Here it is. All right. So let me just pop this up. All right. House passes government funding bill, sends it to Biden. So government funding will go on and prevent the economy, will prevent the government from shutting down at midnight tonight. And that'll help avoid furloughs and, furloughing government employees. And that is, we need that. And that was passed with all the Senates and all the Democratic senators, and I think 15 Republican senators. It was passed in the House with all of the Democrats in the House voting yes, and a good number, I think 25 or more Republicans voting yes to pass it as well. All right. Oh, here it is. Passed that's 254 to 170. 34 GOP reps voted for it also. So, okay, that's a little bipartisanship there. But that's one thing. The next thing is the debt ceiling. The debt ceiling talks about how much we could borrow. And we're the only major country with a debt ceiling. Someone thought it would be prudent to set a budget and limit what you could spend. And I agree with that. That is prudent, but we're talking about a country. We have to raise the debt limit because we are exceeding our borrowing capacity while we have bills to pay. And we have to pay the bills. Raising the debt ceiling has nothing to do with the future. It has nothing to do with infrastructure projects and stimulus and whatever else, child tax credit. This raising the debt ceiling is for the expenses that the United States has already incurred, and now we have to pay the bill for stuff that we spent money on, for what we wore, for what we ate, for what we did. That's what that's for. And if it's not raised, then we default for the first time in over 200-year history, 200-year plus history on our treasury securities. That is not supposed to happen. We have enough infighting, but we cannot let this artificial thing of the debt ceiling stop us. We can always hammer out a new debt ceiling. We could always figure out what to do with the federal budget, the national deficit, the debt deficit. We could always figure these out, but we're always waiting to the last minute until there's a crisis, and then everybody gets their sound bites in. What a horrible way to govern. We should be talking about the debt ceiling for 2022 like tomorrow. We should start debating that, not wait until September 30th of 2022. Okay. Joanne, hey Joanne, how are you? Joanne, I haven't seen you here for so long. I miss you. Except when I get to wish you happy Catter Day. Those are cool. Okay. I heard here's what Joanne says. I heard holiday shopping is going to be rough. Get your orders in now. Going to be a lot of shortages. You bet, Joanne. This is going to hit people like a ton of bricks. You know, toys are out. Game consoles are definitely out. There's probably a lot of people buying up stuff now, and they're going to sell it on eBay at exorbitant prices. And I guess some people are going to pay those high prices to get stuff for their kids and whatnot. But yeah, you're absolutely right. It's just a weird time. There's so many strange things. I know. I'm sorry. Love the new background. Quite all right. Thank you very much. And anytime you join me, namaste. I appreciate it. So that's about it. I think I'm going to go. Happy Thursday. And I don't do the live stream on Fridays. Just I do this 4 days a week, Monday through Thursday. I love doing this. I love you. Thank you so much. Oh yeah, car leasing. I am so happy, Joanne, that we don't have to lease a car now. Like, we got our cars right before we got our cars in like February of 2020, right before the whole damn thing fell apart. I am so glad we don't have to go through that now. I do work only 2.5 miles from my office, so I suppose I could either rollerblade, I love rollerblading, or I could ride my bike to work. But just so dangerous riding bikes around Long Island, isn't it? Anyway, yeah, so tough times. So we've got the budget ceiling that has to be raised. And then we have to see how the COVID variant slows down, and it is slowing down, and that's going to help. And then we have to see how the regime changes. Are we in a place of rising interest rates for the next 40 years? Because we just finished 40 years of falling interest rates. That's a huge regime, and I think that's really going to be the story of the day for the next literally couple of years. What do you say, Joanne? I'm coming out of a lease in the same car. The same car is another $200 to renew. That's you know what? How about motorcycles? We should all be riding motorcycles. Can you imagine? Yeah, it's crazy stuff. So glad I don't have to go through that at this moment, and I'm not looking forward to it. All right. Yes, insane. And I want to wish you all a great weekend coming up. I'm going to end the broadcast now, and see you guys soon. Thank you very, very much for your support.